An estimated 84% of retirees make the exact same mistake with their required minimum distributions. Not because they're careless, because almost nobody actually explains how this rule works before it applies to them, and by the time it does, the deadline has often already arrived. And the penalty for getting it wrong is steep enough to genuinely hurt a fixed retirement income. Most retirees think required minimum distributions are simple. Turn a certain age, take some money out, done. That's only half the story. There's a first-year trap that can double your tax bill in a single year, a calculation most people either guess at or get wrong entirely, and a penalty that used to be brutal and has actually changed recently, though most retirees still don't know that either. In this video, I'm going to walk you through exactly how required minimum distributions work in 2026, the specific mistake that trips up the vast majority of retirees, the real penalty if you get it wrong, and a strategy some retirees use to avoid taxes on this money entirely. By the end, you'll know exactly what to do and when. Quick disclaimer first, I'm not a CPA, a financial advisor, or a tax attorney. This video is educational only, based on public IRS guidance. Always confirm your specific numbers with a licensed tax professional. My name is Arthur. This channel breaks down exactly how IRS rules, Social Security, and Medicare affect your retirement income every single week. If that's useful, subscribe now. Next week, I'm covering a Roth conversion mistake that quietly costs retirees thousands. Quick question. Do you currently have a traditional IRA or an old 401k sitting untouched? Type yes or no in the comments right now. Let me introduce you to Diane. Diane turned 73 this year in 2026. She has a traditional IRA with a balance of $100,000 as of last December 31st, built up over 35 years of steady contributions from her paychecks. Diane assumed she had plenty of time before she needed to think about withdrawals. She figured it was something for future her to deal with eventually. She was wrong about exactly how much time she actually had. Here's the first thing to understand. Required minimum distributions apply once you reach age 73 if you were born between 1951 and 1959. That age rises to 75 for anyone born in 1960 or later starting in 2033. This applies to traditional IRAs, old 401k plans, and most other pre-tax retirement accounts. The government let that money grow tax-deferred for decades. Eventually, it wants its share. Here's the second thing, and this is the trap that catches nearly everyone. Your very first RMD isn't actually due by December 31st of the year you turn 73. It's due by April 1st of the following year. That sounds like extra breathing room, and most people treat it that way, assuming it's a helpful grace period. It usually backfires instead. If you delay that first withdrawal to April 1st, you still have to take your second RMD by December 31st of that same year, no exceptions. That means 2 full required withdrawals landing in one single tax year, stacking your taxable income and potentially pushing you into a higher tax bracket right when you least expect it, and possibly affecting your Medicare premiums too. Here's the third thing. The actual calculation is simpler than people assume, but almost nobody does it correctly on their own. You take your account balance as of December 31st of the prior year and divide it by a specific number from the IRS life expectancy table based on your age. At 73, that number is 26.5. For Diane, that means $100,000 divided by 26.5, which comes out to roughly $3,764. That's her required minimum distribution for the year. Not a guess, not a round number, an exact IRS calculated figure. Here's the fourth thing, and this is the part that used to be genuinely brutal. If you miss your RMD deadline entirely, the IRS charges a penalty, technically called an excise tax, on the amount you should have withdrawn but didn't. That penalty used to be a staggering 50%, cutting the missed amount nearly in half before you even paid regular income tax on top of it. Recent law changed it, and most retirees still think the old number applies. It's now 25%. And if you catch the mistake and correct it within 2 years, that penalty drops even further, down to just 10%. Still expensive, just no longer catastrophic like it used to be. Let's make that real with numbers. If Robert, a retiree past his first RMD year, missed a $5,000 withdrawal for the year, he'd owe a 25% penalty, which comes out to $50, just for the mistake. Catch it and correct it quickly, and that penalty drops to $500 instead. Either way, it's money leaving his pocket for something that was entirely avoidable with a calendar reminder. Here's the fifth thing, and it's genuinely good news that most retirees haven't heard yet. Starting in 2024, Roth 401k and Roth 403b accounts were completely exempted from required minimum distributions. If you have money sitting in a Roth workplace account, you may no longer need to withdraw anything from it at all during your lifetime, unlike the old rules that used to force withdrawals even from Roth-style workplace accounts. Here's the sixth thing, specifically for retirees still working. if you're still employed at the company that sponsors your 401k and you own less than 5% of that business, you can generally delay RMDs from that specific workplace plan until the year you actually retire. This exception only applies to that one active employer plan, though. Any other old 401k accounts from previous jobs or traditional IRAs still require withdrawals on the normal schedule, regardless of whether you're still working somewhere else. Linda, for example, is 74 and still working part-time for a school district with a 403b plan. Because she's still actively employed there and doesn't own any part of the district, she can legally delay RMDs from that specific 403b account until she actually stops working, even though she's already past the normal RMD age. Let's put Diane's full picture together. Her first RMD is roughly $3,174 based on her $100,000 balance and her age 73 divisor. She has until April 1st of next year to take it, but taking it this year instead avoids stacking two distributions into a single tax year later. If she misses it entirely, she'd face a $1,250 penalty on top of the taxes she already owes on the distribution itself. To be fair, RMDs aren't inherently a bad thing. This is money you saved specifically because of the tax break you received decades ago when you contributed it. The mistake isn't taking the money out. The mistake is mishandling the timing, the calculation, or the deadline, and paying an unnecessary penalty for something that's actually simple once you understand the actual rules. Here's a strategy that surprises a lot of retirees. If you're 70 and a half or older and charitably inclined, you can send your RMD directly from your IRA to a qualified charity instead of taking it as personal income, up to $111,000 a year. That distribution still counts towards satisfying your RMD requirement, but it never shows up as taxable income on your return at all. For retirees who don't need the extra income and give to charity anyway, this single move can meaningfully lower their tax bill every single year. So here's exactly what to do. First, calculate your exact RMD amount using your account balance and your age-specific divisor, rather than guessing or estimating, since even a small miscalculation can trigger a penalty on the shortfall. Second, if this is your first RMD year, seriously consider taking it in the same calendar year you turn the required age, rather than delaying to April 1st, to avoid stacking two distributions together. Third, set a calendar reminder well before December 31st every year going forward, because missing this deadline is one of the most common and most avoidable retirement mistakes there is. Fourth, if you have multiple retirement accounts, confirm which ones actually require an RMD and which ones, like Roth workplace accounts, may now be exempt, so you're not withdrawing money you didn't actually need to touch. If this cleared up something you've been putting off thinking about, share it with a parent or spouse approaching this age, because most people find out about this deadline the hard way, not ahead of time. Drop your age in the comments below. I read every single one. If this helped you, hit like and subscribe, because I break down exactly this kind of rule every single week. I'll see you in the next one.